Hi, and welcome to Futures Discovery on John Lothian News. I'm your host, Cortez Draper, and on this program, we'll embark on the fascinating world of futures and learn from top professionals in the field. Today's episode is focused on the intriguing world of block trades and futures trading. Block trades are a cornerstone of futures markets, represented by large-scale transactions executed off the public auction system. They provide a discreet avenue for significant market participants to maneuver substantial positions without the immediate impact on market prices typically seen in open outcry trading. Today, we're peeling back the layers of block trades, uncovering their nuanced dynamics and exploring their pivotal role in the futures market ecosystem. Block trades are distinguished by their size and the discretion involved in their execution. These transactions allow for institutional investors and large traders to buy or sell sizable quantities of contracts without disturbing prevailing market prices. This capability to operate discreetly can be advantageous, particularly when managing substantial positions or executing large orders swiftly. Regulatory oversight plays a pivotal role in mitigating risk associated with block trades. Exchanges and regulatory bodies enforce stringent guidelines to ensure these transactions adhere to market rules and do not unduly impact price discovery mechanisms. This regulatory framework aims to balance the need for transactional discretion with the imperative of maintaining transparent and orderly markets. Price negotiation in block trade involves direct interaction between counterparties, often leading to negotiated prices that may differ from prevailing market rates. This process requires careful management to ensure fair market value is achieved, preventing any potential for market abuse or unfair advantages. Moreover, the sheer size of block trades introduce unique risks, particularly credit risk. Dealing with a singular counterparty in these transactions necessitates rigorous credit assessments to mitigate the potential fallout from default or non-performance. Additionally, block trades can influence market liquidity dynamics. While they offer a mechanism for executing large trades efficiently, their absence from the public market can impact overall liquidity, potentially hindering small traders from executing orders promptly. Concerns about the misuse of block trades highlight ongoing challenges in market oversight. The scale and discretion of these transactions make them susceptible to misuse for purposes of market manipulation or insider trading, necessitating vigilant monitoring and enforcement by regulatory authorities. And there you have it, a quick overview of the complex terrain of block trades, revealing both the strategic benefits and the inherent risks they pose on market stability and fairness. As the futures market continues to evolve, understanding the intricacies of block trades remains essential for all participants, from institutional investors to individual traders. To gain deeper insights into the dynamic world of block trades, let's talk to Arthur Bass, current managing director at Wedbush Securities, with a wealth of experience in the financial industry. Arthur has also previously served as a managing director at COEX Partners and New Edge, bringing over 2 decades of experience to our discussion. Arthur, thank you for joining us today.
Thank you for having me.
Of course. What are some of the primary advantages of executing block trades compared to regular trades conducted in open markets?
Okay, first let me start by just saying a block trade is a private negotiation between parties, as opposed to a bid or an offer you might put on screen, or if it's sell for options on the floor. A block trade is private. They're private transactions, although they are reported after a short period of time on the CME's block website. The advantages of a block trade are really privacy, as well as the ability to get more size or liquidity done. By that, I mean, with privacy, if a customer wants to execute a large transaction, let's say you want to do 20,000 of a butterfly or a 1x2 or whatever structure, or buy just futures, if you put the bid on the screen, that could actually, maybe somebody will hit you, but it could also scare people away. By negotiating a block, you're able to get that done with privacy. And in the case of, the floor still exists for SOFR options. If you execute on the floor, people may guess who you are, via the broker you're using or whatever. If you do what's a block, there's complete anonymity. As I mentioned, there's access to larger size. Market makers may be more likely to show you a larger bid or offer when they know they have a window to hedge their position before it becomes public. They also might show you a larger size, when they can get a better sense of the total trade that you're trying to do. Also, because it's a negotiated trade and you are negotiating, there's a conversation and a business relationship develops, and liquidity providers are more likely to want to deal with people that they know and they understand and they have some trust in terms of the type of business they're doing.
If I'm another participant looking from the outside in, how do exchanges and regulatory bodies ensure transparency and fairness with these type of transactions?
There are time limits for reporting the trade, and if you go on the CME website and search block trade, the CME has a page for block trades, and you can filter it for the products that you're looking at and everything else. Generally, during the normal Chicago trading hours, which they define as 7 a.m. to 4 p.m. Chicago time, block trades have to be reported within 5 minutes. At other times of the day, the early morning, which they call the European hours, or the late at night, which they call the Asian, it's 15 minutes. The 5-minute reporting time, certainly it gives people a little bit of time to unwind or hedge their positions, but it does provide transparency. There's one change to this that actually, believe it or not, started this week on Monday for Treasury futures block trades. The CME allows a 15-minute reporting time rather than a 5-minute reporting time if the block trade is double what the minimum amount is. And let me define that. Let's say for 10-year futures, the minimum for a block trade is 5,000 contracts. So if you do a trade of 10,000 contracts or more, you can have 15 minutes to report rather than 5. And that's really to allow the liquidity provider more time to get out of a trade. And just to put it in perspective, the CTD on the 10-year contract, the TY contract is essentially the 7-year, and 10,000 contracts is equivalent to about 1.7 billion years. So, it's a decent sized transaction. So I certainly can understand the allowance of more time before reporting it. But even with that, it's pretty rapid transparency.
How, as a market participant that is not executing a block trade, can I see this? Will I be able to see them disclosing this block trade from the outside looking in?
If you go to cmegroup.com, search for block trade, it is very easy to get directed to their site, which reports block trades.
Can you walk us through that process and talk about how it differs from maybe an open market price discovery?
In a normal trade, one would either on screen do an RFQ and request a quote, or if they're doing SOFR options on the floor, have your broker get a quote from the pit and you quote a structure. It's 2.5 bid at 3, or whatever the price is, and you can show a bid or show an offer. A block trade is very similar, except it's larger size. You have minimum contract levels. One important distinction with a block size, with a block trade as opposed to just a normal trade on the screen, is you can discuss, there's what they call pre-execution discussion. You're allowed to discuss your direction and the total size that you're doing because you're asking them to quote a block trade. It's a special type of transaction that's not permissible on the floor or on the screen. If the market maker gives me a market, let's say he's 4 bid at 5 for block size, I can show him a bid. I could say, hey, I'm 4.5 bid for 10,000 of my option structure or whatever, and it's a negotiation. He may say, fine, I'll do that. Or if not, I'll say, fine, can you offer it at 5 where you showed me, and do a trade there, and you come up with a price. It's price discovery.
How do market participants manage risk when engaging with these large-scale transactions?
I guess there's 2 types of risk. By risk, one, there's counterparty risk, which I think you're referring to for part of that, and that's monitored similar to any other trade. I mean, my firm Wedbush, I've trading limits for each account. And if I want to execute on screen, that's programmed in. So if I try to put an order on some more than I'm authorized, I get an error message. And so if you're doing a block trade, when you need to enter the trade, because it's entered either on CME Direct or Clearport, if I exceed that level, I have a problem. And given I mentioned there's a 5-minute time frame to record trade, and you got to put the legs of the trade in, you got to put the counterparties in, you got the account numbers right. And there's a lot you really need to look at. If I run into exceeding a trade thing and I have to do a fire drill, that's an issue. You don't want to run into that. But in terms of monitoring the credit, it's basically your firm is monitoring just like they monitor any other trade that you would trade on a platform. Pure and simple, and otherwise it's a trade on the CME. It's got the same risk as any other CME trade has. So you've got the clearing, all the clearing members behind it, and you have the risk parallels that the CME does to mitigate risk, which has worked well for the last 80 years or however long the CME's been around.
We talk about size here. I mean, that's really the essence of this block trades. How does that impact market liquidity when executing large quantities like this, both positively and negatively?
I look at block trades as an addition to market liquidity. I started doing them after the 2008 financial crisis. Prior to the financial crisis, liquidity on the floor is still pretty good, but it was incredible. I mean, you could get size done without a big problem, and pretty much what you wanted to do after the crisis, because banks were pulling back and whatever, it wasn't as much. So then you want to try to do a structure and you get 5,000 done, then you got to pay a quarter tick more, and you incrementally do things that we began to more aggressively look for liquidity provider counterparts, and started doing more block trades. And it was a huge help. I mean, because I think I mentioned earlier, if you have a large structure to do, and let's say you want to do 40,000 of something, and you block 20, and then you trade 20 on the floor on the screen. I mean, then the block gets reported that you're increasing market liquidity, or at least the amount that you can get done for the customer. One thing I want to mention between futures and options blocks, because trading a futures block is not dissimilar from going into a dealer and just saying, offer me, 500 million 5-year notes, offer me, 5,000 5-year futures. That the major players in futures blocks are the large dealers, the big banks, the dealers, the people that are used to in treasuries and swap markets, being lifted or hit on size. Although some of the Chicago market makers are also active in it, but the reverse is true in the option markets. It's the Chicago market making firms that are the more active in terms of the option markets. They've got their expertise in the deltas and the different managing the risk in that type of thing. So I think that's an interesting point in the marketplace.
What are some regulatory challenges and considerations specific to overseeing block trades, and how are these challenges addressed in practice?
Okay, the main regulatory issue to me is the customer suitability. And that's addressed 3 ways. I mean, one, you have the minimum size of the trades, which we went through some of the minimum size, which are substantial. Interestingly, for some of the newer contracts, like the mortgage contract and some swap contracts, they're a lot lower because of, just they want to get volume going on it. But, the minimum size is its first criteria. Second, a customer has to give specific permission to do a block trade. They don't need to do it in every trade, but you need to get that permission that you can execute block trades for them. The third, the CME has a minimum 25 million of assets under management that they require as well. But I mean, I think that's, I chuckle on that, because if you don't 25 billion, I could be doing anything anyway.
What advice would you have for young investors looking to navigate the complexity of block trades?
My advice would be the same as dealing in futures and options.
Yeah.
One, you want to know the markets. Okay, you want to know the market levels. If you're looking at doing a trade, you want to know, well, where is this trade? Okay, so if I'm looking at it and somebody's quoting me a level, is that a reasonable level? Where did it settle yesterday? How much has the market moved? Where is it being quoted? Because you can get a quote on anything on the screen or on the floor. So you want to, one, know where the market is, and two, you want to know the broker or counterparty that you're dealing with. So if you're a customer and you're looking to execute, you're going to want to use a broker that you have confidence in, both for their ability in the marketplace, plus you get along with them and dealing with them, and does it fit? And so, it's really the same as just dealing in the markets in general.
So Arthur, we appreciate your time and insights into block trades. Your wealth of experience and expertise has provided a unique and enriching perspective, contributing significantly to our explorations of the dynamic world of financial futures. Thank you for being a part of Futures Discovery.
Thank you for having me. I appreciate it.
If you're enjoying the content today on Futures Discovery and want to learn more about derivative markets, look at some other videos on our series, but also check out Options Discovery hosted by Esma to learn more about the space.